Okay, we are live. Welcome to the 7 mistakes first-time home buyers make webinar. I'm Emmett Dempsey, Treasure Coast Mortgage. Without further ado, let's go ahead and get to it. Go ahead and share the screen here. Okay. Okay, here we go. 7 mistakes first-time home buyers make, how to avoid mistakes and begin building wealth with real estate. Okay, about me. I'm very much Cheryl's husband. Okay, I'm father of four, age 19, 6, 6, and 4, twin boys. Mortgage professional since 2007. So I was there where the rubber meets the road during the crash and the rise. I funded hundreds of loans as a banker, broker, big banker, you name it. I'm a U.S. Army veteran with a first duty station out of college was Korea, and then in Fort Bragg jumping out of perfectly good airplanes. And then I'm currently a mortgage broker owner of my own company here in Port Saint Lucie, Florida. Okay, what we will cover today in this webinar: why buy a house. Always start with the why. Wait a minute, isn't a crash coming? We'll talk. I know I heard that a lot where I sit. We'll talk about the market and interest rates. And then, of course, the 7 mistakes first-time home buyers make and how you can avoid them and start building wealth with real estate. Okay, why buy a house? Except for the beautiful pictures I have up here, for the lovely pool, the granite countertops. I mean, houses are beautiful. We all love looking at houses, but let's talk about the why to buy a house as a first-time home buyer. Who hopefully that you are, or somebody that is. There's a survey called the Survey of Consumer Finances. It's done by the Federal Reserve. It's conducted every 3 years by the Federal Reserve. The last one was in 2019. So the next one will be next year. So the purpose is to help the government and the public at large understand the financial condition of families in America. So I know we in the mortgage industry use this survey just to look at trends, look at housing wealth, buy versus rent, etc. Okay, the results. Homeowners have 40 times greater net worth than renters. 40 times. If you're 40 times more likely to do anything, you would do that thing. Or if you're 40 times more likely to get hurt, you wouldn't do that thing. So it's staggering. It's not even close, guys. It's 40 times greater. And not only that, and for 2020, there's a quote by the National Association of Realtors economists. A typical homeowner in 2020, just by being a homeowner, they would have accumulated around $24,000 in housing wealth. Okay. And that's by Lawrence Young, chief economist at NAR. And also the trend is increasing. So like I said, we have data, every 3 years. So back in 2010, 198, 209. So you can just see over the course of the years, it's increasing. So why buy a house? To build wealth. That's the bottom line. Okay. Moving on. Wait a minute. Isn't a crash coming? That's what all my friends happened. I was there in 2008. I know it was scary and it's going to come back around, right? Well, we're going to talk about some actual data, facts and math, as I like to say, about why that may not be the case. Why I don't believe it will be the case. Let's go take a look. Okay. All right. Question. What drives crashes, economies, etc.? On a macro level. Basically, supply and demand. In an imbalance of supply and demand, too much supply, not enough demand, too much demand, not enough supply, etc. So let's look at the supply. Record low housing inventory in the United States. You can see in 2007, right here, it was 3.7 million. Okay. Whereas today we're at 1.28 million, and that's actually lower. I've seen some stats where we're actually under 1 million homes for sale. So you can see we're at the very peak, the average over the year since 1983. So about 2.5 million units. Right now we're at 1.28. So that's the supply. So a drastic less of supply. Let's look at the demand. This is one of my favorite charts. This looks at the bursts of every single year from 1928 until 2012. Okay, so different generations. So I'm a big proponent of demographics. I think they tell a huge story about what's going on. So this is the United States. So basically your silent generation, your World War II generation, most of those have passed on. Your baby boomers, who many may not know, are no longer the biggest generation in America. The millennials are. Generation X is my generation, and then your post-millennials, Generation Z, what have you. So the average age of a first-time home buyer is 33 years old. That's the median age, median, not average, it's a median, 33 years old, okay? So just keep that in mind. So this point right here is 2006, which was the beginning of the end of the housing crash. That's where 33 years old in 2006. So 33 years old minus, 2006 minus 33 is 1973, which is right when Roe versus Wade happened, when abortion was legal, just general, all those different trends, from abortion to just less of a birth rate after the boomers. You can see just the sheer drop in people. There just wasn't a people to buy up that supply that I'd showed previously on this slide, 3.7 million, to buy it up. So, get back here, 2006, this is where we're at today. There's a huge millennial trend. Most millennials have, that's the median age of 33 years old. It's trending upward when they're forming households and moving out. And that's where we're at today. And then you can see we have an increasing uptrend of new 33-year-olds coming into the market. So basically, a high demand, less of supply. The chances of a housing crash are very low based on that. Okay, so let's go and talk about mortgage rates. All right, here we're at. That's just my dog. Sorry. Okay, so basically, we're at interest rates. You can see from 2016, we're at a historically low rates. And when I first started, guys, 2007, interest rates were 7%, and that was all the rage. You can talk to your parents, grandparents. They're basically, they can basically tell you that rates are double digits. Whereas I think we got spoiled off low rates, but even so, even back in 2018, I was doing 5%. And 2020 rates dropped into the twos. I've done some borrow 15 years fixed into the high ones. But here's the trends going forward. So still historically low, slightly more than 2020, but still extremely low interest rate market. Okay, so why buy a house? Is it still a great time to buy? Buying a home helps build family wealth, as we talked about, 40 times more. Record low inventory, works for you as a seller. If you're someone that most first-time home buyers, the inventory works for you. So as you're buying, your house will appreciate, so you can move up as your family gets bigger. I know I've done that personally. Increasing demographics of buyers. There's going to be more and more 33-year-olds coming into the market to buy up your house should you buy today. So there's not going to be a drop off in demand like we saw in 2006, 2008 crash, and still very historically low interest rates. Okay. All right. So here, basically 7 mistakes first-time home buyers make, how you can avoid them. Let's go ahead and talk about them right now. Okay. Number 1, of course, shopping for a home before you're pre-approved. Look, guys, I know we love homes. They're beautiful, open houses. You get to see all these, especially here in South Florida, amazing pieces of property you can see, especially your waterfronts, whatnot. Where I live in my community in Port Saint Lucie, it's beautiful. You want to go look at homes first. I understand the draw to homes before loans, because loans, nobody dreams of waking up and getting hundreds of thousands of dollars of debt. But unless you have a lot of cash, that's just the reality. So that is a mistake, shopping for a home before you're pre-approved. Let's go ahead and explain why. Why a pre-approval first works for you and why it's a good idea. Okay, you will know the numbers. How much home can you afford? That is one, I do online marketing. That's one of the most searched for to Google terms, is how much home could I afford on my salary or what have you. That's just questions people ask. And that might have brought you to this webinar, doing that search in Google. How much home can you afford? You can focus on the right markets. Okay, so you know what you're qualified for, that you're not over shopping, or you might be qualified for more. It might work for you. It's like, I didn't think I could buy that big of a house, or, I need this house, or I need this space, or I can shop in markets you didn't think you're qualified for. But getting pre-approved, it helps to hone your search. You can shop with the confidence of cash buyer. Just to know, you can see a house, this price range, you can kind of, what your monthly payment's going to be and what's going to cost out of pocket. You just know the numbers, and it won't be a guess. Okay, you understand the cost involved. Of course, many realtors won't even allow you to look at a house, especially in this hot market. With multiple offers, you can't walk in there and say, "Oh, well, I need to get pre-approved." Like, they're going to say, "Okay, thanks. I've got 10 more other buyers who are pre-approved." So it's not even close. Okay. My pre-approval process as a mortgage broker of Treasure Coast Mortgage, this is the way that I do it. Basically, we do a discovery call, kind of, go over it's goals based, go over your go over your goals, and go over your numbers. Like, here's how much I have to put down. Here's what I want to do. And all those things. We'll kind of figure out the possibilities. That's what we do. It's called a discovery call. So we discover what you want to accomplish. Okay. Document collection, standard, W-2s, pay stubs, bank statements, whatnot. We make it easy. Online tools, online applications. You can upload documents. Despite push button and get mortgage is out there, but it's really not much reality. I try and have get mobile friendly. Through apps, whatever works for you, whatever is easiest. And we do a strategy call. Okay, so we go over your loan options, and believe it or not, there are options. I know many times we say, "Well, what's your rate?" Like they ask the wrong questions. So my job is to lay out options, because it doesn't matter which loan product that you pick. We all get paid the same. So we lay out the options that are possible. Here's different down payment amounts. Well, I'm getting a gift for 20% down, and we'll talk about that in a minute. So my job is to give you options about what is possible. Okay. And then we'll do a mortgage coach TCA, or send a video. I know people are busy. A lot of times I'll record a screen share video with a mortgage coach, which is a tool that I use to help lay out the total cost analysis of different options. Here's what your cash to close is. Here's the cost over 5 years, 15 years. It kind of helps, give you a projection, by buying today, what's going to look like in 5 years, 15 years, all option 1, option 2, option 3. So that's what I help to provide clarity of options before, and then of course the pre-approval. So when you're out shopping, and again, to increase your confidence as you're out there looking, and this is in a perfect world, you get pre-approved before you're shopping for homes. Okay, and then you go shop for homes. So next is what a mortgage coach will typically look like. Basically, here's a $300,000 purchase price, 5% down conventional, 3%, 3.5% down FHA or VA. This is just an example, of this is a buy versus rent analysis. You can see the net monthly savings. Part of the 40 times net worth is just by making your payment. It's called amortization. So you just by making your payment each month, you're building wealth, even if your appreciation is zero. So that's a lot of the drivers of the wealth building effect is amortization. Of course, appreciation is just a cherry on top. Okay. Number 2 mistake, not having a professional dream team working for you. Okay. So your team, of course, this mortgage guy right here, he's not so bad. So your pre-approval, affordability, and if you're not paying cash, realtors, I have several great realtors locally who know the market. Another kind of sub mistake, I guess, is assuming that the listing agent works for you. And you might go to an open house, think, well, the agent will get a deal and they might give me a deal. Like, yeah, no, they get paid the same from the seller no matter what. So it's just have a buyer's agent that works for you. And a lot of times there's homes that come on the market that you don't see on Zillow or any of the portals. I mean, I've worked in real estate offices. I've seen it. I've seen pocket listings going on where they never hit the market. They say, I have a buyer looking for this, and they say, hey, I'm about to list this property. Here you go. I mean, that's what happens every day. Of course, you're a home inspector. You definitely want a home inspection. It's technically optional. In my opinion, it shouldn't be optional. To bind insurance in Florida, you'll need certain insurance inspections, like a wind mitigation, as well as a 4-point, depending on how old the house is. I know insurance is kind of home inspector insurance. I know a 3 and 4 here, but they're kind of intertwined. I know insurance is changing. I know Florida just implemented Citizens state insurance again, just because insurance changes all the time as far as what they'll cover. I know roofs are a big issue. They want you to have upgraded roofs. So just having those good agents, inspectors, and usually for folks who are moving to the area, I usually refer these out from realtor on down. So they just get pre-approved, and then everything's just taken care of. Okay. Number 3, underestimating closing cost and ongoing costs. Now, basically the cost of a home consists of 3 things: down payment, closing costs, and prepaids. Everybody thinks, well, I have 3% down, 3.5% down for FHA, and that's all I need, right? And they just kind of do the math. There's closing costs. In the state of Florida, there's doc stamps because there's no state income tax. So they make their money through intangible tax and deed stamps. So, and many times, the seller will pay the deed side, which is 70 cents per thousand, but you have to check your contract. A lot of builders don't. They make you pay that. And so there's certain things that sellers will pay, usually the deed stamps on the contract price, as well as owner's title policy. You have to have title work done, not to mention that. So, and then there's your closing costs. I mean, the lender sides are very little, so usually I'll charge like a 795 processing fee and maybe any discount points if you want to buy down your rate. And that's a personal decision, on a case by case basis. And then there's prepaid items like your first year of insurance. You get paid 12 months of insurance up front, like we talked about, and plus 3 months to buy for the next year. So you have your escrows, depending on how big the tax bill is, your prepaid items can be bigger than your closing costs. So so it's just all, and again, part of the pre-approval process and the discovery and strategy is looking at all those costs, and I'm an open book. One of the things that you'll see if you're shopping is that you'll get wildly different, different cash to closes, so it's just that the cash to close consists of these three things. I try and be very much upfront and to know exactly what you're going to pay. So the ongoing costs. The taxes and insurance changes, and especially if you buy a new construction property, your tax bill is based off of the land. So once the county gets around to reassessing it, your taxes are going to jump, just because it was based off an artificially low tax bill. That's number one. And your insurance, it can change just every year, just through sheer inflation, or or something happens, with that carrier, or if you have another hurricane, so those are potential things, and that's usually part of your mortgage payment. And you can say, well, my payment jumped. It's like, well, not necessarily. Your taxes and insurance jumped, because most of what we do are fixed rates. So routine maintenance, more of if you're in an HOA, if I'm in an HOA, there's certain things that I'm on the board of my HOA, certain things we ask our homeowners to do, like, get a new mailbox doesn't look bad, or just, redo your roof as far as, cleaning it, just routine maintenance. Just understand if you're in an HOA that would be even more. Your major items like your roof, your paint, AC in Florida, they go. Your AC is on pretty much all year long. So you definitely need to, plan for those things. Maybe prepare a contingency fund and know the home that you're buying. Of course, newer homes, not as much maintenance, but they have their own caveats as well. Older home, maybe you may get a good deal, but plan for more maintenance. And of course, when you're looking at insurance costs and things like that. So it's just, you had to factor all those costs into it. Okay. Number 4, credit. Knowing scores and correcting errors. So it's very important that you do that, because credit drives the train. So basically, and then in Credit Karma, it's just a guide. It uses a different model called the Vantage model, not the FICO model, what we use in the mortgage industry. So use myfico.com if your credit is a question. Most of the folks I talk to who know their credit's good, it's going to be good. So if you're on, on these artificial, I guess, borderlines, like 700 is one, and also 640 is another. So if you're near any of those kind of, and they're really pricing borderlines basically, and they can, by 1 point from 639 to 640, it's a drastic change. It can be a drastic change in interest rate and cost. So knowing what your scores are up front, very important. Of course, any major derogatory, bankruptcy, foreclosure, short sale, you must disclose to me up front. You'd be surprised. I've had things go into contract, and what happens is the lenders, they'll do LexisNexis, the entire country's databases, and they find it. I've had borrowers and say, oh yeah, I forgot about that. I mean, they really thought I wouldn't find it. and they lost their deposit and things like that. So that's just a mistake, and not being honest about your credit up front. There's any kind of possibility, when it comes to foreclosures and short sales, well, I was sort of on this property or not, like, it has to be disclosed, and that way I can nip that in the bud right away. Or a bankruptcy, like if you had a foreclosure and a bankruptcy, I can pull your bankruptcy paperwork and just knock that out. I mean, the more we know up front, the more that we can attack as we're, guiding you through the underwriting process. Okay. And, when I pull credit, we'll look at rescore strategies. Sometimes when I pull credit, it'll give me, of course, the middle FICO score, and then like a plus whatever, if there's potential score improvement, if we need to get above those hurdles, especially if you're near 640 or 700, it can really change, it's a game changer. Of course, a big theme lately is student loans. That's what I see more and more first-time home buyers have student loans. Are you an income-based repayment? Because if you're a conventional loan and if income-based repayment, and usually when I pull the credit report, it'll say $0 for the payment. And then if you're an income-based repayment, I can use that zero. It helps you qualify for more. Or if you go FHA, it's 1% of the balance. And conventional Fannie Mae will use 1%. Freddie Mac will use 0.5%. So if you have significant student loan balances, we need to identify those because that can really affect your affordability, maximum debt to income. Okay. And then of course, identify and correct your errors, and then we'll help you do that. Okay. All right, moving on. Number 5, assuming you need a 20% down payment. I know it's, they did other studies. I don't know where exactly it came from. I know that a significant amount of people still think that 20% down is required. Okay. When most people don't put 20% down. This is from Experian. The average down payment on a house is 13%. The average first-time home buyer puts down 7%. Usually, your FHA loans, like I said, 3.5%. And then conventional does have a 3% down option. As long as you're a first-time home buyer that we define as haven't owned a home in 3 years. Okay, that's the technical definition of a first-time home buyer. Okay, and then where does the money come from? Almost 60% from savings account. Any kind of gifts. If you're buying a house from a relative, you do a gift of equity. You're always trying to find options. Now, I know you might be inquiring about down payment assistance options. That's something that I do personally. I believe, there's programs out there from the state. There's other colleagues of mine that will do them. I don't like them. I don't believe in them. I think they cause an artificial cloud. And basically what they usually are silent seconds to sit on your property and you forget about them. I've had some refi clients that come to refinance and they say, wait a minute, my payoff should be this. And they're like, did you get down payment assistance 5 years ago? Oh yeah, I forgot about that. And they just forget that there's a mortgage sitting on their property until they go to refinance and they need cash out for something else. And then it comes back to bite them. So, but I mean, and look, if that's what you need, that's what you need. That's fine. I would refer you to colleagues who do those things. So just keep in mind a lot of, the increased rate and costs for those things for down payment assistance. Okay. Look at all the options. Doesn't have to be 20%. Usually what I try and do is usually shoot for FHA 3.5%. You can have the seller, pay up to 6% in your closing costs. That's one tactic. Again, it's a case by case basis based on what you're trying to accomplish. And another thing too, if you're selling a house and you're not necessarily a first-time home buyer or a move-up buyer, or you're getting a large gift, it doesn't swing your payment as much as you think it does. And then part of when I look at, and I do a mortgage coach for them, I'll look at different purchase prices and different down payment amounts, and then like, whoa, it's really not that much. One common tactic I do is basically, it's called 15 is greater than 20. It's kind of, well, if I put down 15% versus 20%, it's a significant drop in cash and it's a tiny bit of mortgage insurance. Yes, you will have mortgage insurance on conventional FHA for putting down less than 20%. However, you can use that mortgage insurance to your advantage. So, especially in that 15 versus 20% example, it saves some cash out of pocket. The drop in payment, the mortgage insurance is minimal. Of course, it's all FICO dependent, but you use a mortgage insurance to your advantage and do that. So, cash is king. Like I said, use it wisely. And again, part of what I do pre-approve is I look at all your options. Okay, income, not knowing any income issues. Okay, now debt to income still drives all mortgages. Until they change the rules, debt to income is the number one factor for approval, for yes or no approval, even for manual underwrites versus your Fannie Mae, Freddie Mac systems. Your debt to income is still the quote unquote risk factor that they look at to determine whether a loan is risky. So, the debt is one portion we talked about for credit and student loans, et cetera. But this is the other denominator, which is your income. Okay. Especially self-employed. Self-employed, there's multiple programs out there. If you, depending on how you file your taxes, all those things, we have to really analyze that, especially in 2020. Some lenders have very overlays to see if your business is still healthy moving forward after the shutdowns and whatnot. And so you have to really look at that. Of course, new jobs, change jobs, 2-year history is important. We're going to see, also variable income is a big thing too. If you start a new job and then your entire income is overtime, that's a problem because you need 2 years total. So, or if you have second jobs, One common misconception is that, like, I know I work with a lot of nurses, who have multiple jobs, worked at different places. So you got to have 1 year at your second job in order to use that income. I know the guy, there's some lenders that'll tell you it's 2 years, it's actually 1 year. So it's just knowing your unique income situation is a mistake. And just assuming that it is what it is. But talking with me, knowing guidelines, we'll look at it. Of course, the 1099 income switch, I say, hey, I took a 1099 job, it pays me more, or if your company switches to 1099, that's not good for you, because sometimes it'll reset you to have 2 years of file taxes to use it. Okay, it's not good. Of course, working for family as another one. We just have to account for that. There's certain rules for that. So just knowing your income situation, and that's all part of the interview process when we do the pre-approval to see if there's any issues there. Okay. All right. And last but not least is number 7. I love this Jackie Chan meme. It's like, why? Applying for credit before the loan is funded. And I've had this happen way more times than you think. Like, you can get all the way to the very end and then clear to close. Yes. Okay. You're about to sign tomorrow, and then go out and get a installment loan to buy furniture or a credit card. And truth be told, I did this when I did my refinance. My wife and I laugh about it. Yes, I applied for a Kohl's card to get some Kohl's cash, but it was a VA roll. It didn't have DTI requirements, but technically I did do this mistake. I'm not a first-time home buyer, but first-time home, and it can affect you, because usually a lot of lenders will do I call it a credit refresh, and they'll see, and if it can affect your DTI, especially if you're borderline and you're just qualifying. You got to be very careful. Just wait till after the loan is funded to apply for these kind of things. Okay. All right. So that's kind of it in a nutshell as far as the 7 steps about why to buy a house. Hopefully we brought it all home about, yes, you're ready, Emmett, to go out and buy a house. Okay. What are the next steps? Okay. If you go to dempseymortgage.com, get in the pre-approval process. You can put your information. I'll give you a call back. We can schedule your strategy call. Okay. We'll look at your family's unique situation. All right. And we'll implement a strategy based on your goals. And we'll start building wealth for real estate. Okay. Do we have any questions? Okay. Well, thank you so much. Hope to help you and your family on your first-time home buyer journey. Talk to you soon.